Hey guys, I want to go over a few stocks that have recently fallen. So as we know, the S&P 500 literally hit an all-time high yesterday, and believe it or not, there are some stocks out there that are not at all-time highs. Like check this out. We have ASML. They are down 35% plus on the 3-month chart, but they just reported earnings yesterday and they're down like 16%, or well, they're down 6.4% right now on this day, which is kind of crazy. But let's just say they fell because their Q3 bookings came in half of what analysts expected. So they said that people are they're delaying their orders into 2025 and 2026. So that really sent the stock falling down like crazy. And it sent a lot of the other stocks down too, like Nvidia, but actually ASML was down 6% today. Nvidia actually recovered off that. They're up 3.13% today. So it's really just ASML that's holding the back there. We also have a story from LVMH Group. So LVMH, this is the one that owns Louis Vuitton, Hennessy. Their CEO was the richest guy in the entire world, or publicly known people that are the richest in the entire world. His net worth is actually now in fifth place. He went from first place, now he's in fifth place with the only $182 billion market cap, or fortune. I don't know why I said market cap, but that's all that net worth is tied in with whatever the stock does, because he owns so much of the stock. But yeah, LVMH Group fell a lot because of China, weak demand in China, and we'll look at what their earnings were a little bit more. They still say they have a cautious consumer. So that's LVMH Group. We'll also look at Celsius and Elf Beauty. So Celsius Holdings, this one has went from $100. Look at this. They were $98 just, 6 months ago or whatever. And now they're down to 33. Well, they actually have had a nice recovery off this bottom right here. They went from 28. Now they're chilling at $33. And then we also have Elf Beauty, which is always an interesting name that I like to watch because the cosmetics industry has insanely high margins, and Elf Beauty seems to be a growing competitor right now. And check this out, their stock price went from $200 plus, now they're at $100 just in 6 months. So not great stock price performance. Some of these are growth stocks, some of these are dividend stocks. But yeah, we're basically going to be doing a quick analysis on all these stocks, seeing are they a buy, because I kind of do want some exposure to ASML and maybe even Elf Beauty. LVMH is one I like, but they're not an American company. But we'll check them all out because they do own some strong brands like Hennessy, Louis Vuitton, and they also own Dior, which they do a lot of collabs with Nike, which is kind of cool. And their stock prices have looked very similar. Like Nike and LVMH have kind of performed similarly. But yeah, let's go ahead and get into this video. Don't forget to drop a like. It would really help me out a lot. And let's just get straight into it. We'll start with ASML. So now let's check out ASML stocks. So as we know, that their bookings came in half of what the analysts expected, but I actually have a quote here from the earnings call, and he said that chip makers aren't canceling fabs, they're just delaying them to get visibility into 2025 and 2026. Which, if you ask me, that kind of sounds bad because they don't have visibility now, and maybe there are some warning signs. But anyway, let's check out what the S&P Global estimates were. So despite all that, they actually slightly beat on their EPS estimates and their sales. They beat on all that, and they slightly beat on their EBIT estimates. So that's a good sign. But check this out. Their free cash flow was down 13% year over year, which isn't that big of a deal. They're just investing into the future, because if we look at their actual net income, they were up 9.67%, which is good, to $2 billion in the most recent quarter. So let's actually see how much their dividend costs. So they made $2 billion in the most recent quarter, and their dividend only cost $600 million a quarter, which is around a 25% payout ratio, which is pretty cool. All right, so here's ASML on the Simply Safe Dividend website. They're rated an 82 for very safe, their dividend. And if we actually look at their dividend history, it's very impressive. It's basically a straight line up. So they are a really good dividend payer. But check this out. Here's what's really attractive about them. Look at their forward PE ratio. It's at a 23. I'm not sure how accurate the forecast is for next year's numbers, but if it's accurate, they're trading at 23 times forward earnings, which is the same dip as 2020 and down here in 2022. So those are some insane dips, and their dividend their dividend yield is above their 5-year average at 0.97%. So yeah, nearly a 1% dividend yield, which is pretty cool. They're a mega cap, $286 billion company. And if we check this out, if the forward earnings are correct, that's a 13% forward payout ratio and a higher dividend yield. So that's a lower payout ratio than Apple and a higher dividend yield than Apple, which is kind of cool. But their trailing 12 months payout ratio is a 35%. So that's kind of a big difference there. So that's what I don't know. And I'll show you this down here as well. So here's actually the expected earnings per share. It's supposed to be $24 next year, the next forward earnings. So that's why their forward PE ratio looks really low. They're doing a multiple off this 24 right here. And same with their free cash flow per share. Remember, their annual dividend is around $6 per share. So that really is like a 15% payout ratio if they're making $24 or if they're making 22. But $17, that's actually quite a difference. But yeah, that's all I really wanted to show you about this company. They're also doing some share buybacks, which is, a good sign. They're not diluting you at least, which is good. So 394 million shares outstanding, well down every single year. And look at their total sales, their total revenue. It's at nearly an all-time high, which is great. That's an insane growth rate. So yeah, a lot of people want exposure to this industry. They make the chip making machines. They're an AI play, semiconductor play. So yeah, that's kind of my analysis on ASML. All right, so now let's check out LVMH stock. So this one owns Louis Vuitton, Hennessy, Moet, Dior, and check out the stock price. It's really not pretty, but here's what I like to look at the company in terms of valuation. It's very similar to Nike. They're currently trading at 19 times earnings, which seems pretty fair. That's actually a little bit cheaper valuation than Nike right now. So, actually Morningstar says this one's at a $140 price is a fair price. But anyway, check out this. This is kind of why the stock fell. So look at their largest market. It's Asia excluding Japan. And in their most recent earnings, the sales fell 16%, and it's the third negative quarterly performance in a row. So their largest, segment of revenue keeps falling organically, which is not good for the company. This is as a full year 2023, so we're not looking at the most recent numbers, but yeah. And since China is their largest market, I had some notes from the investor call. They said that the Chinese stimulus packages have yet to boost consumer appetite there in China, which kind of makes sense because remember, if you're in China and you're a Chinese consumer, you've pretty much gone through hell since 2020. And you're not really going to trust this stimulation package. And yeah, because of all this, their growth rate has really stalled. Like, look at their earnings per share growth rate. It's negative from last year. You can see the most recent quarter, it's 727. Last year was 847. Like, here's their sales growth. So their total revenue is also negative 1% year over year. So that's why the PE ratio has come down so much, because the growth has stopped. But check this out. I do really like this company for their brands. And look at their annual dividends per share. They keep raising it every single year, but do beware, they did cut it right here. It actually went down. So they're not exactly, going to be a dividend aristocrat or anything like that. But yeah, that's kind of my thoughts on LVMH Group. All right, so now we're going to look at Elf Beauty stock. And I'm going to show you why this stock is a pure growth stock, because their total sales numbers are going to impress you. Check this out. They are up 50% year over year. In the quarter before, they were up 70%, 80%, 70%. So look at this total sales growth rate. So this is proof that they're taking market share. I mean, you can't make this up. These sales growth is really impressive. So that's why I call this one a pure growth stock. But right now, they don't have their net income perfectly, aligned with that growth rate. So their net income is down 10% year over year, but still they are profitable. It's not like they're losing net income. So that's a great sign. So they are EPS positive. Their free cash flow per share does look a little wonky. That just means they're kind of investing in their future. And since Elf Beauty is such a high growth stock, I want to go out to 2025's numbers. So we have all these analysts right here. We can see their forecast for 2025, and check this out. So for 2025, I'm going to take the average price target right here or average EPS target of $4.48. So right now the stock price is $107. So we're just going to go into the calculator here, do $107 divided by, we're going to go with the average one right here, $4.48. So they're actually trading at, wow, 23 times 2025's numbers. And when you start to look at it this way, Elf Beauty, since they're such a high growth stock, starts to look reasonably valued and not insanely overvalued at this level. 24 times 2025's numbers. And that's the average one. If we go out and do $5.68, this would be like 19 times earnings or, something like that, way cheaper. But yeah, that's kind of my thoughts on them, because if we look at their valuation right now, they're trading at 51 times earnings, which seems really expensive. But remember, we saw their total sales growth. It's insane. It's up over 50% year over year. And their forward PE ratio says 30 times. But if we go up to 2025, they're trading at 23, or we'll call it 24 times earnings. So that's why their price to earnings growth ratio is a 1.86. So yeah, that's kind of my thoughts on Elf Beauty. Let's go ahead and get into the last and final stock. All right, so finally, we're going to look at Celsius stock. So this was the one that has that really popular drink that everyone likes, and they were just around $100, and now they're trading at $33. Looks like the growth rate has absolutely collapsed. So let's go ahead and look at them. Let's see what their numbers look like, because look at their EPS growth. Their EPS is really just their net income per share, and look at this. It's up 54% year over year. So this is some insane growth on their net income. Like, look at that. They used to make and lose net income. Now they're finally cranking out net income. We can look at their total revenue. Their top line sales is up 23% year over year. So the demand for their products is absolutely exploding and still growing. And here's their balance sheet right now. They have a very healthy, monstrous balance sheet. And let's go ahead and look at their numbers though. So I want to dig into their financials. So I do believe this company has a lot more cash than debt, but let's actually verify that. So they actually have $903 million of cash right now. So the whole company's market cap was $8 billion, around $8 billion. And look at this. Yeah, total debt of $289,000. So zero debt. So they have basically $1 billion of cash. And yeah, the market cap is $7.87 billion. So let's do the math on that. Like 14% of their market cap is literally just their cash on hand because their debt is just $289,000, which is literally nothing. And since they have so much cash and little debt, I bet you this company's making a lot of interest off that. So yeah, look at this. They literally made $10 million of pure interest in the most recent quarter. So that's what's crazy. Since they have zero debt and a lot of cash right now, companies with a lot of cash and zero debt actually benefit from the high interest rate environment because they can just keep their cash in the 1 to 3 week treasury bonds and collect, $10 million of pure interest that they don't have to do anything for. So that's what's really impressive about that company. And if we go to their total common shares outstanding, you've barely been diluted, just 1.13% year over year, which isn't that big of a deal. Like, yeah, look at that. They're issuing basically no stock, not even $1 million a quarter, and with an $8 billion market cap, yeah, that's basically nothing. So, yeah, that's actually my highlights on Celsius. Who knows what the future is going to hold for this company? Who knows if they can keep up that growth rate? But right now, I'm really liking this company. 14% of the market cap, we'll just call them debt free. So, debt free and 14% of the market cap is just cash. So, that takes a lot of risk off the table. The only risk is if they have a declining growth rate. And they have an insane growth rate right now. They're still up 23% year over year. Net income's up 54%. I actually wonder if they have some international exposure. So we'll actually check this together. I wonder how much of their money just comes from the United States. The app we're actually using is called Mumu. If you want to help me out, I have an affiliate link in the description, but let's actually check out their market breakdown. So yeah, look, literally 95% of all the revenue comes from the United States. So who knows? They may have some opportunity to go into other countries and gain market share over there because literally the other countries, it's $29 million. That's 2% of revenue. That's literally nothing. So yeah, and this is as of full year 2023, so not the most recent quarter. It could be a lot different now. Who knows? But yeah, that's kind of my thoughts on Celsius stock. I hope you guys kind of enjoyed my breakdown on this. Oh yeah, here's the free cash flow of this company. But yeah, I hope you guys enjoy how I showed you all the numbers. You can kind of draw your own conclusion for yourself. If you have any comments for me, let me know. I will respond to all of them down below. Don't forget to drop a like on the video. Hope you guys have an amazing rest of your day.